Good morning, everybody, and a very happy new year to you. I hope this all finds you well on this slightly chilly January morning. Thank you so much for joining us for our first webinar of 2024, which is our update on charity accounting and tax. My name is Fiona Condren. I'm an audit partner and I'm also BDO's National Head of Charities. As well as colleagues and experts from across BDO, I'm absolutely delighted today to have two guest speakers, Andrew Studd, a partner at the law firm Russell Cook, and Matt Whitaker, who is the Chief Executive of Pro Bono Economics. I'm sure they'll both introduce themselves again at the beginning of their presentations. This session is being recorded and will be shared with you tomorrow or early next week. So if you've missed anything, please don't worry. And if you want to share the content with colleagues, you will be able to do so. We do have a packed agenda, but at the end of each session, there will be a short opportunity for the speakers to answer a few questions. So please use the Q&A function in Zoom to post your questions. If we can answer them as we're going along as well, we will do so. If we don't have time to answer all of your questions today, we'll endeavour to respond to those after the event. We have a 2-hour session planned for you today, but there will be a short comfort break partway through the session, hopefully just around 10 o'clock, and we will aim to close the session on time at 11. So without further ado, I'm going to hand over to our first speaker, Matt Whitaker from Pro Bono Economics.
Thanks, Fiona, and good morning, everyone. Really pleased to be here. As Fiona says, Happy New Year. I hope you've had a good Christmas. I hope you are still basking in the warm glow, because I'm an economist and I've been asked to look forward to the next 12 months or so. And as a trade, we are not known for our optimism. So I'm afraid there will be a bit of gloom here, as the title of this presentation suggests. Actually, for 2024, there is some gain. There is some good news. We are turning some corners. But sadly, there is also a bit of pain around still. And it will be heaped on the shoulders of those probably least able to contend with it, which makes the role of charities all the more important. So if we click on to the next slide, please. Just before I look to the future, I do want to do a quick sort of looking back at the recent past. Now, if you're interested in living standards, there's all sorts of different economic metrics you might look at: GDP, productivity, employment, so on and so forth. For me, the single measure that best captures how life feels in terms of the money in your pocket is this one, which is average real household income per person. And I've shown you here what's happened from 1980 through to 2008. And what you can see is more or less a straight line. So yes, a few bumps, you can pick out the recessions, etc. But this is steady living standards progress. And if we rolled this chart back to Second World War, you'd see the line doesn't change very much at all over that period. We've been used to having very steady year-on-year growth in the income in our pocket, even after you adjust for inflation. But if you go to the next slide, what we see is that from 2008, something happened. And what happened was 3 once-in-a-generation crises happening within about a decade or so. So first, the financial crisis of 2008, which, as you can see, hit incomes pretty severely and for quite a period of time. We had a bit of recovery going on. Then we had the EU referendum. Now, this is not about the Brexit effect. This is simply about the effect of voting to leave, which caused a deterioration in our terms of trade, basically made the country poorer. And so that knocked us off course once again. And then we never really got a chance to understand what was going to happen once we actually got Brexit done, because as soon as we had, along came the pandemic. So what we've ended up with is 15 years or so in which incomes really haven't behaved like they used to, and we've had overall stagnation. And if you go to the next slide, please, then what you see actually is average income growth in that period, in the sort of latest 15 years, just 0.6% every year, whereas we were used to 2.5% a year in earlier times. And as I say, you could stretch that back all the way to sort of 1950, and you'd have the same growth rate going on. So what does that mean in concrete terms? It means had we carried on with those historic norms, what we thought was normal, then by today we'd all have about £6,500 more in our pocket on average. So this is material stuff. Once you take a stagnation and spread it over 15 years, it really starts to matter. And as the pink line suggests, and here's where the gloom comes in, Unfortunately, things are likely to get worse before they get better. So this is the OBR's projection, the Office for Budget Responsibility projection from the autumn statement in November for what happens to incomes over the next few years. And what you see is that through 2024, actually on average, incomes probably fall again before starting to recover, but they never make up that lost ground of recent years. So we do seem to be on a permanently lower trajectory now. And that's really important context for everything else. And if we click onto the next slide, there's another bit of the equation that I want to just think about before we get into what comes next, which is those are all averages, but how are those distributed? And so in this chart, what we're showing again is average annual growth in real terms, household income, but this time for particular time periods and this time spread across the income distribution. So we've got the poorest households over on the left of the chart and the richest households over on the right. And this first line is just showing you what happened in the 1980s, 1980s, 1990. And as we saw from the first chart, we know that was a period in which incomes were growing at a decent rate. What we can see here is, yes, that is true, but it's very skewed. So the top was doing much better than the middle doing much better than the bottom. So actually everybody was getting richer, but in a way in which inequality really took off through the 1980s. If we go to the next slide, we then move into a new phase, 1990 to 2007-8. Again, overall, strong income growth, but now much more evenly shared. At the bottom end, you've got the national minimum wage, you've got tax credits, you've got rising employment, particularly for single parents. You've got all sorts of things that are boosting incomes at the bottom. And at the same time, incomes at the top aren't rising quite as rapidly. So you've now got strong and shared growth. Now, I should say, with all of these lines, I've taken off the very top and the very bottom because the data just gets crazy. In this period, if you had the top 1% on, you would see that they were racing away from everybody else. But for the mass of the population, actually everybody was growing at a pretty similar rate. If you take the next slide, you see what's happened in that 15-year stagnation. So overall, as I said, income growth has slowed down very considerably. But as the pink line is showing here, it's done so in a way which actually hasn't increased inequality, hasn't hit those at the bottom any harder than those at the top. In fact, in some ways, those at the top have done a little bit worse. But it's reduced the growth for everybody. So it's just been a pretty miserable time all round. And the reason why in the title here I've said we've sort of all been in it together is that yes, those at the top may have done as badly, if not a bit worse, from cost of living crisis and so on. But actually, of course, given everything that's gone before, it is much harder to deal with that pinch, that squeeze, when you're already in a constrained position. So although everybody can grumble about what's been going on over the last few years, clearly those towards the bottom end of the distribution have been hardest hit overall. And this is all income inequality. I'm not talking about wealth inequality here, which is very different, or intergenerational inequality. So this is a very particular picture. But actually what we've not seen over the last 15 years is an increase in inequality. What we have seen is a slowdown in growth, a slowdown in the pace at which the pie has been growing at a time when inequality was already high. And that is really important context, particularly for what comes next. So if we move to the next slide, and now we're starting to think about 2024, what we're moving into now is a very different picture, I think. One in which that broad-based pain of the cost of living crisis switches into something in which we have winners and losers, and those losers are increasingly at the bottom end. So we have unemployment is starting to rise again and is projected to get to a point where it's 350,000 higher than it was at its low point in 2023. We've got a combination of national insurance cuts and income tax freezes, which will benefit anybody earning more than 26k, but hit those earning less than 26k. So again, we're putting the pain on those at the bottom. We know that housing costs are going up rapidly. Mortgages are going up, and as people come to remortgage this year, they'll be hit. 1.5 million mortgages this year facing an increase of 1,800 on average, but rents are rising too. Homeowners not being affected in the same way. But those poor renters and those mortgages who are at an early stage in their life will be quite severely affected. We've got very specific withdrawal of cost of living support. So one of the reasons why incomes at the bottom end have been supported in recent years is because we put in new forms of support, the cost of living payments. They are now being withdrawn, and that will, in a very material and very immediate way, reduce the incomes of those at the bottom. And we won't necessarily see this in our pockets, but we do have the potential return of austerity. We know that public services are already very strained by the cuts we've had over the last decade or so. The Chancellor at the autumn statement penciled in plans for another very significant real terms cut in public services. Now, that might not be delivered because it just might not be deliverable, but at the very least, we're probably looking at some more constraint, and that will mean that, again, life will feel that much tougher. So combine all those things together, and if we move to the next slide, please, what you end up with is a pattern of growth in income over the next 12 months, which is projected to look like this. Now, this isn't my data, this is my former colleagues at Resolution Foundation, where I was for a decade before coming to pro bono economics. And what they've got is that for 24-25, income's falling really for the bottom third of the non-pensioner population. So this is a slightly different composition from the chart I was showing you earlier. It's non-pensioners only, it's UK rather than GB, and it's after housing costs. It's not directly comparable with the curves I was showing you before, but it's the same principle. So for the bottom third of the non-pensioner population, they've got incomes falling in 24-25. So as I say, quite a bit of pain around. Yes, some gain for others. So actually for half, if not more, of the population, incomes should be growing again. And given what we've been through recently, that will feel like a good thing, even though we're only talking about sort of half of 1%, which is anemic by historical standards. So for many people, 2024 will feel like a turning point, will feel good, but for too many, it will feel very difficult indeed. So what does that mean for charities? If you move to the next slide, what we've seen is over the last few years already, demand for charity support is elevated. So this is just showing from Citizens Advice, the number of referrals they've made to food banks and other charitable support across England and Wales since 2020. And you can see the rise here, and you can replicate this sort of chart for lots of other charities. This is just sort of indicative, really. So charities are already running hot. Because of the sort of poly-crisis world in which we live, and the cumulative effect of all of those economic shocks that the country has been suffering. So we're already in this position. If we move to the next slide. But we're in this position when the sector itself is actually struggling to find the capacity to meet all that demand. So what we've got here is from the NCBO almanac, the charity income, again adjusted for inflation from all different sources, dating back to around about the turn of the century. In the last couple of years there, the dotted lines are our estimates for the most timely data. And you can see that clearly income has been relatively flat over recent years, and that's already causing problems in a world in which demand is high. But if we move to the next slide, our projection, taking the OBR data for what they think is going to happen to various economic variables over the next few years, linking that back to what that has meant for charity income in the past, and then creating a model going forward, what you get is that charity income probably remains flattish for the next couple of years before starting to recover. And again, what we never do is make up the ground that has been lost since about 2019. So overall, the charity sector is probably looking at about a 10 billion, 15 billion pound gap relative to where it could have been at a time when demand is elevated and likely to be climbing higher still. So clearly that is creating a problem for us. If we move to the next slide, it's creating a problem at a time when other capacity concerns are in place as well. So we know that for the sector, yes, inflation itself might be coming down now, but we've got that sort of time lag in terms of the way in which it's feeding through to pay rises. So right now, average pay settlements are above 6%, which is obviously historically very high, and that's difficult to manage from budgets which are quite flat. And it's actually still not as high as it is in the private sector, so it creates problems in terms of recruitment, because we're finding it harder to bring in the talent when the pay gap, which already exists with the private sector for people who have exactly the same profile, same skill set and so on, that pay gap is growing and has grown over the last few years. So no surprise perhaps that 61% of charities are saying that recruitment is harder than usual right now. We've got financial positions deteriorating, so the cumulative effect of several years of running hot is just getting harder and harder to manage. So 35% of small, mid-sized, 44% of large charities say their financial position has deteriorated in recent months. And we've got volunteering as a challenge as well. So 59% of smaller charities saying that securing more volunteers is a key concern for them at the moment. So we've been running hot, we've got capacity issues. Not surprisingly, we've also got some concerns about welfare within the sector. So as we came out of the pandemic, 75% of charity leaders were telling us they were concerned about burnout among their paid staff and burnout among the volunteers as well, actually. And so what are we looking at? We're looking at a sector that's been running hot and now is at danger of burning out at a time when it's really, really needed. So if we just go to the next slide, and this is my last slide, just to conclude, that overall 2024, yes, some gain, but unfortunately too much pain. So on average, living standards are likely to be fairly flat, but that masks some pretty big differences across the distribution. We've got unemployment, we've got rising debt repayments with interest rates, with housing costs, and growing public service pressure being especially challenging for some, and that some tend to be those at the bottom end of the distribution and the kind of usual suspects, if you like. So, of course, charities will step up because they always do. We've done it for the last few years. We've done it for decades. But the sector's been running hot, danger of burning out now, as I say. And so overall, my message for policymakers, and particularly in an election year, is that it's really critical that they engage with the sector and see it as a key partner. Sort of move away from the kind of culture wars or the idea that charities are just the lowest cost deliverers of public services, to actually seeing charities as a genuine partner, sometimes a critical friend, but a sector that can help tackle the big issues affecting the country in an effective and sustainable way if it is supported to do so. Because actually it's only by being really effective and really careful with how we're using our resources right now that we can deal with the issues we face. Because if we just assume that the charity sector is always going to be there to pick up the pieces, then it's looking increasingly likely that some things are going to break somewhere along the way. So I promised you gloom, I'm afraid. There is some good news in there. Pick that out, and I'll stop there. Thank you. And okay, so I'm turning to the Q&A, and I can see from Christopher Clark, question about the cost of living slowdown being unique to the UK. Absolutely not. So we have seen a large part of what was going on was prompted by the pandemic, and obviously that was global in nature. The UK has, in different ways, suffered more so than elsewhere. Some of that is around government responses. Some of it is around the way, sort of the openness of the economy, and therefore our exposure to international trends. And we're also particularly exposed because of the nature of our consumption. So because we have high levels of consumer debt, because we have relatively high numbers of mortgages, although shrinking over time as home ownership becomes more difficult, the policy response of using interest rates to reduce inflation is that much harder to bear for a relatively small part of the population that have high debts or that have high mortgages. I have another question, which is, how might a change of government change my prognosis? I think in a sort of slightly depressing way, in the short term, not all that much, because the economy is what it is, and we're not going to see any sort of rapid change in the overall state of the economy. So I think there are challenges ahead, no matter what happens. I do think there is an opportunity for change, particularly in terms of the role that public services might play, in terms of providing some of that extra support. That means that charities don't just have to step in and sort of pick up what falls through the cracks, and also I think in terms of the approach to the charity sector and think about charities as partners. So I think there is some potential there for a new government of whatever persuasion, but a government that is perhaps focused on having a plan and thinking about the medium term rather than just where we are with the current government, which is very much sort of day to day and sort of handling chaos. I think there is some opportunity there in the medium term, but I think short term it will be difficult nevertheless. Hugh McNaughton saying, didn't highlight particular challenge to local authority budgets and bankruptcy of councils. Absolutely. You're right. I didn't. At 20 minutes, you almost had enough gloom already. I've just written something separately where I've talked about that, and I think that is a real pressure. And again, if you think about that relationship that charities have, it's with policymakers, often it is at the local level rather than the national level. And you can see that in some local areas, those partnership arrangements work quite well and mean that the two sectors can support each other. But that's becoming increasingly difficult to do because local authorities are just so stretched that they don't have the capacity, the bandwidth to even engage with the sector. And so you end up with this sort of very siloed approach, and that's a real problem. And I think, yeah, that is going to be one of the stories of 2024 is local authorities going bust and local authorities struggling to deliver the services that their citizens need. Let's pick out some more. From Michael Illingworth, are policymakers likely to be interested in engaging? Well, excitingly, I can tell you we announced yesterday that we will be hosting later this month a summit between the Labour Party and civil society, where the Labour Party actually approached us and said, look, election coming, we're thinking about our approach to civil society, how we work with them in partnership. Could we arrange something in which we're able to bring the different sort of sides together and have a very open, candid conversation about how partnership working might look? So that is happening on the 22nd of January. You can see the details on our website. You're able to register online. Please do come along to that. hopefully it'll be a really interesting conversation, and if nothing else, it signals a real intent, at least on the part of the opposition, to engage with civil society, and we're hoping that we can have a similar conversation with the Conservative Party as well. Let's have a look. What else have we got? Do you ever see a world where a charity sector is less necessary and more effective government could lead to a lesser need for charities? I think what I see is a world in which charities are less focused on dealing with the fallout from everything that's wrong with society, and more focused on going upstream and helping us achieve a better society in the first place. And that doesn't happen, I don't think, by charities just acting on their own. I think it happens by, as I say, this sort of partnership approach and saying, okay, what are the big problems facing the UK? What's our ambition for the UK? What sort of country do we want to be? Okay, where are those charities? Where are those civil society organisations that are plugged into what's really going on the ground, and they're actually doing lots of this stuff already? Can we bring them in and think about how we take some of those ideas and scale them and think about prevention rather than it just being cure? At the moment, the Treasury model is very much, if you go to them and say, we're doing this programme, and this is part of the data of what PBE does, we're doing this programme and it is helping to reduce reoffending, or it is helping to keep kids in school and ensuring that they are less likely to get into crime and things like this. It costs this, but over the longer term, it saves you way much more. Then Treasury approach is, that's no good to us. We need cost savings in the next 12 months. And that it has to be wrong. What we have to get to is a world in which we're able to say, oh no, you're right, that is what we need to do. And so collectively, and bring the private sector in as well, collectively, we should be acting to do those things which ensure we have a good country today, a better Britain tomorrow, rather than, as I say, just the sort of the chaos of letting things fall and then picking up the pieces and then expecting the charity sector just to do all that heavy lifting. Okay, that may be the end of questions.
So I'm up next. Hopefully, yeah, sorry, computer froze there. So just by way of quick introduction, my name's Simon Thurston. I'm an Associate Director in the Employment Tax team at BDO. I've been here about 10 years and work with a lot of charities to help them with employment tax advice. Although I am an employment tax specialist, I'm actually going to be covering a little bit on direct tax and VAT as well today. But hopefully you won't ask too many difficult questions in those areas. So first up is employment tax. So I think the first thing to mention here is around some recent HMRC activity. So what we've seen is that HMRC have started to issue some letters to charities regarding undertaking compliance reviews. Now, the focus of the letters has been on looking at processes and procedures around determining employment status. And curiously, the focus so far appears to be on sort of traditional self-employed individuals rather than IR35, albeit across, with the IR35 rules having been in place for 3 years now, and even longer in the public sector, we do expect more activity on that front as well. I'm helping a couple of clients in responding with those letters, and what we've seen is it's an identical letter sent by different caseworkers, so they clearly have a template that they are using, and therefore it has kind of all the hallmarks of a sort of mini campaign at their end. As is usual with these sort of things, HMRC give very short timescale for providing all the information they request, such as details of all the payments that have been made. The focus has been on the 22-23 tax year. And obviously the consequences of a review, as well as, obviously taking up a lot of time to deal with it, even if there aren't any issues. If HMRC were to identify that any individuals who've been treated as self-employed should have been treated as employees for tax purposes, then the engager, the charity, will be on the hook for any PAYE and NIC that should have been deducted at the time. There are mechanisms in place for offsetting tax and potentially NI that has been paid by the individuals themselves, but that will generally, even where that's allowed, there will generally be a shortfall, so there will ultimately be a cost. Another point to add here, which was a recent development announced in the autumn statement, is that to date, it's not been possible to get any offset of tax in an IR35 situation. So if HMRC challenge that you as an engager, a charity, have engaged with a personal service company and should have been treating them as a deemed employee under the IR35 rules, effectively there's no formal mechanism for them to take into account any corporation tax paid by that personal service company, any PAY and NIC paid by that company on a salary to the underlying individual, or the income tax paid via perhaps dividends. So in the autumn statement, and the legislation's only draft so far, there is a proposal that from the 6th of April this year, there will be a mechanism introduced into the legislation. It remains to be seen how well that works, because the current draft legislation uses terms such as a best estimate of the tax that can be offset. So quite how HMRC intend to work that out remains to be seen. What I would say, though, and we've certainly seen HMRC even suggesting this, is that if you do have any live inquiries regarding IR35, that you look to postpone settlement until after April, because then this mechanism will be available to potentially reduce any bill that might be due. Next slide, please. So I know Matt's touched on this already, but in terms of other employment tax recent updates, we've had the reduction in the main rate of employee NIC, which is from 12% to 10%. So that kicked in from the 6th of January. So people will see that will generally see that when they're paid at the end of this month. I suppose, yeah, but by this stage, hopefully all of you, your payroll providers or your in-house payroll teams and software are up to date to deal with that. I think there is some acceptance that not everyone will have been able to get it ready in time, and in which case you'll have to kind of process that perhaps in February once all the systems are in place. Another area that we've had a recent consultation on is regarding salary advances. So, I mean, broadly, this is looking to change the rules on the RTI requirements to match what probably a lot of people have technically incorrectly been doing in practice. As it stands at the moment, if you pay a salary advance, as per normal RTI rules, you are required to report that to HMRC on or before the payment date. The consultation looks to give a little bit more leniency on that, so that you can delay reporting until the corresponding kind of payment that advance is for, essentially. So it remains to be seen, when anything changes on that front, and precisely what that looks like. From a national minimum wage perspective, I think traditionally, I mean, there's been a lot of focus from HMRC on this. A lot of money has gone into their enforcement teams to sort of strengthen them, and activity has picked up. And I know from helping clients, we're helping a lot of clients in this area because HMRC are much more active than they used to be. I think traditionally, HMRC have focused on particular sectors, for example, retail and hospitality, but we have seen a lot more geographical targeting now. So this is where they, it's kind of sector agnostic, and they are just picking out essentially almost random employers in a particular area. So I think Humberside was one that's been targeted recently. So I think the key message here is, I suppose, employers that don't traditionally pay an hourly wage or have employees on an hourly wage have often thought that, you know, they're pretty low risk from a minimum wage perspective, and that's not what we've seen in practice, because the rules are horrendously complicated. They're almost like another set of they're almost like tax, but you know, a completely different rule book. And we have seen cases of, you know, people on, in theory, very, very high salaries and tripping up on this and finding that, you know, the employees are actually being paid below minimum wage. And obviously that gets very expensive. Generally, you know, if you make errors and they aren't picked up before HMRC come along, then you know, there's potential naming and shaming as well. And we've seen some very, very large household names named and shamed, and I think the next cycle of that process is coming up shortly. So we expect to see you know, many more names on that list. Just moving on to holiday pay, sorry, quickly. So this is a lot of people will be aware of the Harper case, which ultimately went to the Supreme Court and essentially told employers and even ACAS, because their guidance was wrong, that the approach being taken to irregular paid employees or employees who are so-called part-time workers, so they had periods of the year where they weren't working, this 12.07% methodology for working out holiday pay turned out to be wrong. So the government has just now announced, as of the 1st of January, but I think this kicks in from April, effectively changing the rules back to what people thought they were in the first place. Now, there's been a lot of guidance issued on this. It is quite complicated, but what I would say is if employers haven't looked at holiday pay, and particularly if they have workers working irregular hours or part year workers, definitely look at this, because it's likely that you'll have to make some changes to your processes from April onwards. There are very strict rules on rolling up of holiday pay. I mean, if you do take that approach, these rules clearly set out that you need to pay the rolled up holiday pay in every pay period. You can't pay it, say, quarterly, which we've seen some employers do in the past. And there are also rules dictating, you know, the carry forward of unused holiday as well. So it is very complicated, and I would encourage everyone to look at the guidance on this and make sure that they're ready for the changes from April. In terms of the historic position, certainly in higher education, we've seen a lot of clients take a sort of wait and see approach. It remains to be seen if there's going to be, you know, any policing of the pre-April 24 period, or whether it's going to effectively just come down to the profile of your workforce and whether they're likely to, you know, to try and make any claims via tribunals. Next slide, please. I appreciate there's some questions coming up. I will try and deal with those towards the end. So on direct tax, there's just a couple of quick updates. So one is regarding the first is regarding the Digital Markets Competition and Consumers Bill. So the concern here is around the requirement to repay membership subscriptions, and the fact that that can or could cause issues from a gift aid perspective, because generally speaking, you can't claim gift aid on a payment that is subject to repayment. So groups have been lobbying to effectively either change the bill itself to provide an exemption for charities, or to change the gift aid rules to kind of get around this issue. It remains to be seen what solution does ultimately arise, but hopefully there will be one, because otherwise this is potentially quite problematic. Next slide, please. So this is around a recent HMRC consultation. Well, that happened last year, where they're sort of looking at the some of the tax reliefs available in this sector, and obviously keen to tackle non-compliance. The areas under review are listed there. I think that the key message on this is our view is that the areas that they've been focusing on aren't really particularly problematic in our view, and the existing rules are quite adequate. We were expecting some other announcements in the autumn statement following this consultation process, but that hasn't happened yet. So I think it's just a case of waiting and seeing what happens on this front. Just like this, yes. So now moving on to some VAT points. So my VAT colleagues have kindly put together a list of recent cases that are applicable to charities here, some of which you may be familiar with. So I think, again, the key message here is that the eligibility for VAT reliefs and exemptions for the charity sector continue to be litigated by HMRC. As I said, those cases are worth a read if they are applicable to the particular area of this sector that you work in. But in particular, I think that the key message is that the courts are continuing to construe the exemptions and reliefs narrowly, and that's certainly HMRC's approach. And therefore, if you're relying on any particular reliefs and exemptions, you need to take care. HMRC have issued updated guidance and manuals on certain areas, which are listed at the bottom, towards the bottom of the slide. But obviously, like everything, this is just their interpretation of the rules, so we don't always agree with that. And even the courts themselves have sought to challenge some of HMRC's guidance in the past where it proves incorrect. And I think the Yorkshire Agricultural Society, the case at the top of the slide, is that was the case there. The one area where there has been sort of an expansion in the availability of reliefs is regarding energy saving materials, and so those do still prove to be an area for opportunities for savings for charities that incur expenditure in that area. Next slide, please. In terms of HMRC activity, and I think this is probably true across the taxes, we've gone through a period of where they have been a bit quieter, and that's starting to sort of pick up again now. We're also seeing that HMRC are quite slow generally to respond to things. So from an administrative perspective, and that's certainly true on my side in the employment tax area as well. So I suppose, very broadly speaking, if you're doing anything where you need to do a registration or approach HMRC on any matter, try and do that as early as possible, because it's likely to take quite a long time to get a response from them. If that leads to issues with you're waiting on HMRC and not quite sure what to do, that's where professional advice can help in the meantime. In terms of HMRC going out, there's increasing use of nudge letters. Again, they're doing the same on the employment tax side, and those can lead to large VAT assessments in some cases. And I think, in view of the time, I will pause there and just pick up on the questions.
Thanks, Simon. I was going to say probably just got time for one or two.
Yeah, okay. So the first question from Stephanie there regarding who falls within IR35, essentially, I think there haven't been any changes. So broadly speaking, unless you're a public sector organisation, you have to be, if you're small under the kind of Companies Act definition of a small entity, you should fall outside of IR35. And I know in the charity sector, broadly speaking, grants don't count as turnover, so that can sometimes mean that relatively large charities sometimes aren't caught within IR35, but there hasn't been any change there. Huge question around freelancers, any particular learning points. I mean, I think obviously a lot of organisations have been using HMRC's Check Employment Status for Tax tool, which is more helpful than having nothing, but is potentially dangerous, because what we sometimes see is people with little experience of HMRC's questions in that area using it and perhaps accidentally answering questions incorrectly or not in the way in which HMRC would expect a particular question to be answered. So what I would say, I suppose if you're making big use of freelancers, that's certainly an area you want to make sure that your processes are sufficiently robust. But there hasn't, the case law on employment status continues to evolve, but the main areas that HMRC focus on haven't really changed in recent periods. So Andrew has asked around why NI increases come in from the 6th of a month. I mean, that's just because in the world of tax, we work in tax months. So that's just a quirk of, I mean, it's like, we're the only country with a 6th of April to 5th of April tax period. So that's just the way it works. Unfortunately, the last few questions on charitable donations and museums and galleries exhibition tax relief, I would have to get one of my direct tax colleagues to go back on those if required, because as I said, I am an employment tax person. But I think that's my time up, so I will pass on to Andrew, who's going to...
Thank you, Simon, and thank you very much for inviting me to be here today. I'm going to do a very high-level fly through some of the developments that, if I can have the next slide, please, just briefly to explain what we're going to cover. A few developments at the Charity Commission and some of the Charity Commission's new guidance, some outcomes of inquiries and compliance casework, a little bit about case law, and what is on the horizon. So, can we have the next? Thank you very much. The Commission continues to exercise its regulatory powers more than it has historically. There are 169,000 charities on the register. It has something like 500 employees. It obviously cannot monitor each and every charity. So when it does find some wrongdoing, or what it likes to refer to as misconduct and mismanagement, it does exercise its powers with a view to setting examples for the sector. So just between July and September 23, it opened 715 cases of regulatory concern. It closed 921, which was good, and there are 755 ongoing. Those are just relatively low-level inquiries where the Commission gets involved, but doesn't necessarily have to open a statutory inquiry. In the same period, the statutory inquiries, they opened 5, closed 24, and there are 114 ongoing. Historically, this is a high level, but it is the basis on which the Commission exercises its resources or applies its resources to the sector. They have also introduced a new annual return for the years starting 1st of January 23 for reporting years 1st of January 23, with a lot more questions requiring more detail from charities. It's designed to help the Commission fulfil its regulatory function, i.e. it gets better information from charities, and it helps identify where their priorities are as to what sort of information they need from the Commission. They do expect you to put that return through your My Charity Commission account, which is a new process whereby contacts for the Charity Commission have a sort of registered number, and they can submit information directly via the portal. There have been a few problems with that, but generally speaking, I think it's a helpful resource reducing exercise. And just to note, the Charity Commission's CEO is due to retire this year. That probably doesn't create many implications because the CEO does what the board wants. We've had a new chair relatively recently, and it tends to be the chair that sort of sets the tone. So I'm not convinced there's going to be a big change from that. We can have the next slide. So you will be aware that the Charities Act has been being implemented in stages. The first stage was in October 22 and the next one in June 23. The Act is facilitative. It provides, rather than wholesale changes, it provides little helpful points in areas, for example, Royal Charter bodies that want to change their charter. They now have a power to do so. The next tranche, and the final tranche, I think it will be, is expected in March 24. The one area they're not going to be implementing at this stage is the regime around ex gratia payments, which was meant to make it easier for charities to give ex gratia payments when they felt they were morally bound to do so. The reason being that there's a bit of a fear that charities, certainly museums, will use that to facilitate the return of objets to their original place of creation. So, for example, the Elgin marbles. The Charity Commission have also introduced new guidance for charities which use social media, which I would expect is a very large chunk of the sector nowadays, especially if you're a fundraising charity. The Commission says you must have a social media policy. The guidance sets out what that policy should broadly cover. It does require that you can demonstrate as a charity that your use of social media helps you achieve your charitable purposes, whether that's fundraising, whether that's campaigning. Various activities are permitted, obviously. They don't require the monitoring of personal accounts, but they do flag the point where you have a sort of high-profile CEO who is speaking on their own behalf, but is known to be associated with the relevant charity. If that CEO is supporting the Labour Party or the Tory party in particular issues, certainly in this election period, they do expect you to be very careful and to have a considered view as to the separation between that individual's role and the charity itself. They do confirm you can undertake campaigning and political activity via social media. You can campaign on emotive topics, but you must do it with respect and tolerance. And that's a new concept that the new chair of the Commission has generally introduced. My colleagues at BDO will be much better talking you through the new internal financial controls for charities guidance. That was updated in April 23. It's been redesigned and updated. It's got some more detailed guidance in it, for example, in areas around fraud and cybercrime. The Charity Commission has also updated its guidance for investment matters for charity trustees. That was in August 23, reflecting the Butler-Sloth case. The Butler-Sloth case was the case that went to court to clarify the scope by which charities can undertake ethical investment. There wasn't a material change in the law, but it does emphasise that charity trustees are duty-bound not to take their own proverbial foibles into account. They do need to be thinking about what's in the best interest of the charity rather than what their personal views might be on a particular matter. So if I could have the next slide, please. So here are a few examples of some inquiries in compliance casework. They're fairly random, actually, covering all sorts of different bits and bobs, but they are exactly where you do not want to be. So the first one is the Cowsby Trust, where the Commission was alerted to suspicious activity on the charity's bank account. They investigated and found that there was only one trustee, whereas the governing document required 3, which is the normal approach. So that's already a problem. They then subsequently found the trustee had lent himself £100,000 or so to update his own home, and had spent £69,000 on a couple of mulberry long case clocks, which were allegedly an investment for the charity. They were subsequently sold for something like 26,000. So evidently not a very good investment. There were no records. Clearly, there were conflicts in the decision-making process. The Charity Commission concluded that that was a breach of trust, and the individual trustee was disqualified for 10 years. Salutary tale, follow your governing document. Care for Calais is a refugee charity, so it's always in the limelight. It's quite often in the media. There had been a history of engagement with the Charity Commission, but again, they found that there were insufficient trustees to take decisions because a number of the trustees were connected to each other, and one of the trustees was also the CEO. There were no decision obviously taken by the trustee body. There were no minutes, so I think the CEO had been off making decisions without conferring with the trustee board. They also found that money had flowed through a trustee's bank account for very good reasons, that they were thinking they were saving exchange rate charges. But the Commission took the view that that put the charity's assets at risk. You should really never be putting money other than through official channels. There were also a number of other points that were raised. The Commission decided that they would appoint new trustees to the charity. They gave extensive advice and guidance and put in place an action plan. So that charity is now sort of in special measures, as it were, for the next period. Hospice Aid UK is an interesting one, where a charity entered into a fundraising agreement, a direct mail fundraising agreement. And we've seen a number of these where the fundraiser essentially assumes the benefit of the arrangement. In this case, only about 1% of the income from the fundraising went to charitable causes. So the Commission had been engaged with Hospice Aid previously, and they were concerned that they hadn't followed previous guidance. They instructed the charity to make sure that they had clearer reporting on the terms of the contract and the expenses, etc., in their accounts, and the charity received an official warning. Charity Commission hasn't used official warnings that much, but I think there's a trend to see them being used a bit more. Similarly, for Christchurch Oxford, they received an official warning for allowing a dispute to run out of control. They spent something like £6 million on no doubt lawyers and others in trying to resolve the dispute, but those costs were approved retrospectively. There was no budget, there was no anticipated cost estimates for what this dispute might cost, and you can understand that you don't necessarily know how much it's going to cost, but to approve costs retrospectively without having any forethought was the issue that the Commission got concerned about. Also gave them an official warning. I'm going to skip over a Syrian church because it's very complicated. Multiple issues involving potential funding of terrorists, an entry in the accounts that referred to Iraqi hostages, which seemed to imply that they had been paying money to terrorist organizations. So that was all about financial controls. Again, my colleagues at BDO will be better explaining what needs to be in your financial controls when you're operating internationally, certainly in areas of high risk. The Gerald Kergaven Will Trust involved a charity which owned an estate in Cornwall. The charity trustee, the charity is established to support Marlborough College, but it was also running this estate in Cornwall, and any profits were being applied to the Marlborough College. The trustees decided that they would sell the estate, and the residents were clearly very upset about this. I think the benign landlord was rather appreciated. But I think the trustees were duty bound to consider whether owning an estate was really in the best interest of the charity for producing future income. They decided to sell it. The commission was approached by the residents, but concluded that the charity trustees had followed the appropriate processes. They had written minutes, they had justification for why they were doing it, etc. And the commission said it's not for us to interpose our decision on the charity trustees. And finally, on this one, the Jim Ratcliffe Foundation. This is one of those ones where high-profile people attract media interest, and a media story gets the Charity Commission engaged. It turned out, or it appeared, that the charity had funded a ski club in Courchevel to the tune of 12.5 million euros, and clearly that raised all sorts of questions. Exclusive ski club using charitable funds. It turned out actually that the funding was provided to a proper ski club, as in one that supported kids and taught them how to ski. The exclusive Courchevel Ski Club actually only used a very small part of the building, and the membership fees from that were applied to the charitable purpose. So it was actually a sort of trading activity. But I think the question that this answered, so the commission didn't intervene. They said that they thought it was fine. There were a few other issues about all the trustees being employed by Jim Ratcliffe's companies, and they did insist that an independent trustee be appointed. But it's a point about media, but it's also a point about how you present various things on your website or the information you put into the public. If in the current environment, media are going to attach themselves to it or be attracted to the story, you do need to be very careful about how you present that. So very quickly, next slide, please. Case law update. The first case I'm referring to here is actually a non-charity case, but it's about if you are going to remove members from a membership organisation, the court says you must apply the process of natural justice. So that now applies regardless on membership organisations if you're going to have an expulsion. You may remember the Frank Wingett Cancer Relief Fund. This was a gentleman who spent £410,000 over cancer relief charity building a 200-foot Welsh dragon. The statue actually wasn't ever built, but the commission went back after Mr. Wingett's son, I think, and recovered £117,000 from him. I'm going to skip over mermaids as well, because that's a relatively technical point about whether mermaids had standing to challenge the commission's registration decision, and actually they concluded they didn't. Zedra Fiduciary Services is an interesting case about the National Fund, which is a fund of about £600 million, which was set up some years ago designed to pay off the national debt. There's been a lot of talk about whether that's a good use of that money. The trustee went to try and get consent to apply the funds for charitable purposes, but the courts decided that that was not following the intent of the gift. So CPRE, which is a concept where you can't fulfill your charitable purposes, allows the commission to adjust those to something close by, reflecting the economic and social circumstances. But the court came back to say, no, if you give it to certain charities, not everybody in the nation will benefit. If you reduce the national debt, then it will benefit all of those within the nation. Trustees of Mountain of Fire and Miracles Ministries. This was the appointment of an interim manager, where they were appointed to the exclusion of the trustees, but the interim manager essentially couldn't work without the engagement of the trustees. So it's a case about the charity going back to the commission to say this doesn't work, and the commission having to amend their scope. I'm going to skip Wilson given time, and Friends of Victoria Hall is another interesting case about local authorities holding assets on charitable trusts and then sort of forgetting and trying to sell them on their own terms for their own benefit. This was a situation where the Charity Commission eventually got involved to say, yes, they are charitable trusts. We will give you a scheme because this building is ineffective by itself. They concluded the Friends of Victoria Hall said that that's not appropriate, and they challenged the Commission scheme. The court concluded that the Commission had to rewrite the scheme. So that's a very quick slide through that. Briefly, what's on the horizon? Some of these, actually, the Economic Crime and Corporate Transparency Bill is actually now an act, so forgive me for that. There was an economic crime law introduced earlier in March 22, requiring overseas entities that own property in the UK to register their beneficial owners. This is the next sort of stage of that, which allows Companies House greater powers and investigatory powers, obviously, to look behind corporate structures. It's likely to result in a requirement to identify your directors and your people with significant control. So there may well become a lot more admin. We're all sort of slightly used to proving who we are in anti-money laundering situations. I think this is going to apply to Companies House. The Data Protection and Digital Information Bill is amending UK GDPR. The only point I wanted to flag in this, which hopefully will be helpful, is there is a little piece of legislation called PECA, which prevents charities using electronic marketing with its donors or stakeholders unless they have specific informed consent. In the commercial sector, there's something called the soft opt-in, which means that if you have approached a company for information about their products and services, they can come back and approach you trying to sell you similar products and services. So this may enable charities that are approached, somebody expresses an interest in their mailing list, it may allow them also now to go back and say, well, you're interested in the mailing list, how about giving us some money? So that could be helpful. The procurement bill, again, is going to amend the existing regulations. It's going to be very complicated. There will be some very technical changes. Thankfully, I don't have time to go through that now. The Kids Company judicial review was already suspended when Camilla Batman-Gellish became unwell. Given her death, I think that will cease, but it's rather sad because there was a very different perspective on that case from the Charity Commission and the High Court, which us lawyers enjoy debating every now and again. There will obviously also be a general election coming up. The Commission has been very good, I think, actually, about encouraging charities to say you can campaign, you can undertake political activities, but as Matthew identified earlier, you have to be equal-handed. So if you invite the Labour Party to something, you probably ought to demonstrate you've invited the Tories to come as well. The point about this is there is also other election regulations in relation to non-party campaigners, where if you undertake activities intended to influence voter behaviour, you could be required to register, and there are all sorts of consequences for that. So you do need to be very careful about whether calls to actions or creations of manifestos as part of your campaigning could require you to register. The review of the financial thresholds is really just to say, as we've had lots of inflation recently, it's likely that some of the financial thresholds in the Charities Act and elsewhere will be upgraded, but we're not really certain about that at this time. I'm sorry, that was rather a quick rush through. I hope I'm not too late. Do I have time, Fiona, for a couple of questions?
Yes, you do, Andrew.
Please clarify when new annual return effective presumably applies to charities. I believe it applies to charities. I believe it applies to all registered charities, and it's if you have reporting periods from the 1st of January 23. And then, have you seen any new guidance from the Commission or requests for them asking charities to declare more donor information, i.e. source of funds for large donations? No, but there is a duty to identify your donors. It's a little bit vague as to what, when and how, but you should probably have a policy in place about accepting and refusing donations. In this current environment where we're involved in culture wars, you will recall stories around the Sackler Foundation and their lots of organisations wanting to distance themselves. A charity can't, on its face, just refuse to take money. So you should probably have a policy as to who you're going to take money from, how you go about identifying who those individuals are, especially if they happen to come from, say, a sanctioned Russian individual. So I hope that's okay. I think Fiona maybe has the pleasure of introducing the comfort break.
Thank you, Andrew. Yeah, it's 10:05. At this stage, we're going to offer you a 5-minute comfort break. So just hopefully enough time to grab a quick drink. So we will start back at 10:10 exactly. So thank you. Welcome back, everybody. As I did say, we were going to have a very quick break. So I'm delighted to hand over now to Robin Harwood, who is a senior manager in BDO's technical standards team, to talk us through the accounting and technical update. Over to you, Robin.
Great, thanks, Fiona. So we're going to have a short run through this morning of a few updates. We're going to start with an update on FRS 102, which will include the proposed amendments in the FRC's exposure draft. And this will just give a flavour of some of the changes rather than the full detail in the time we have today. I mean, you may or may not be pleased to hear that. We'll also touch on where we are with the SORP update, and then run through briefly a few other topical financial reporting matters as you look to prepare your next set of annual report and accounts. So first of all, if we just look at the FRS 102 update. Now, I mean, as you may already be aware, the FRS 102 has been through its second periodic review by the FRC. So about a year ago, it issued Financial Reporting Exposure Draft 82, or FRED 82, which proposes changes to FRS 102. Those changes will then have a consequential impact on the charity SORP. So following initial consultation period in September, the FRC announced a delay to the release of the final amendments. So we're now expecting those to come through in the first half of this year. And they've also delayed the proposed, pushed back the proposed implementation date. So the proposals now are for it to come in with to be effective for periods commencing 1st of January 26. The FRC's proposals currently permit restatement at the date of initial application. So if there are changes to the numbers and balances in your accounts that will be required from the changes, just to give an example, if you're a December year end, under the proposals, you will be able to restate your opening position as a 1st of January 26, as opposed to going back all the way into 25 and restating all of the comparators to 25. So it's one of the sort of concessions and simplifications in the proposals. So this slide just sets out a sort of brief summary of the key proposals in FRED 82. I mean, the principal changes are around revenue and leases. So bringing in revised accounting requirements based on the principles that are in IFRS 15 and IFRS 16 respectively. I'll come on to each of these next, but so just to not lose sight of, there are various other proposed incremental changes and clarifications within FRED 82, include things like a new section 2A on fair value measurement, requirements around positive statements on the going concern basis. I'm not going to cover these in any more detail today, but no doubt will be considered more once the changes are finalised later this year. We just move on to revenue. So FRED 82 proposes to bring the same requirements that are in IFRS 15 into FRS 102, but just described a little bit more succinctly. The first and foremost, this will impact charities from a contract income perspective. So charities perhaps with contract for services or other contract income, trading, some trading contract income, that kind of stuff. It won't directly impact the recognition of non-exchange transactions. So So your grant income, your donations income, your legacy income. This is more focused on contract income. The core principle that is being proposed here is that revenue will be recognised to depict the transfer of promised goods and services to customers. So once a promise that's made in a contract is satisfied, that's the point that you then recognise your revenue. This slide just sets out in the bottom half there the 5 sort of steps that preparers are required to go through in determining revenue recognition. So just very briefly, step 1, to identify your contract, maybe a legal contract, but a contract always includes enforceable rights and obligations between a vendor and a customer. You identify the promises in a contract. A contract may just have one promise. A contract may have multiple. One of the key things is that the individual promises need to be separable, and the customer needs to be able to benefit in isolation from each of those promises. Step 3 and 4, so you determine the transaction price, the overall revenue number from the contract, and then you allocate that revenue against each of the promises in a contract. And this is really where there may be a degree of estimation in how you apportion income between the different sort of components of a contract. And then you recognise income once those promises are satisfied. So just from a kind of thinking ahead perspective, if you are a charity with contract income, you will need to ultimately go through this 5-step process and assess what is the impact on revenue recognition. So if you don't already, having things like a complete contract list, documentation of the terms of those contracts, what promises are made under each contract, those types of things are going to be really key. If we just move on to leases, so on balance sheet lease accounting will be brought into FRS 102. There are some optional simplifications from IFRS 16, but ultimately this will bring significant changes in accounting and reporting requirement for lessees. There's relatively very little change from a lessor perspective, so we are really thinking about lessees here. So almost all leases will be recognised on balance sheet as a right of use asset, and then you have a corresponding lease liability. So this differs to the kind of the current treatment of operating leases. There are some exceptions. So exceptions where leases are short term. So that's where leases have a term of less than 12 months. Or where leases are of low value. The proposals, when we say low value, the proposals are that's driven by the type of leased asset, as opposed to the reflection of the significance or materiality to an organisation. So things like mobile phones, home printers are specifically identified as low value, irrespective of the size of the organisation. Whereas things like vehicles, land, buildings are specifically not low value. Just at a very high level, the asset and liability will be recognised at the present value of lease payments remaining. There are some other elements that flow into the initial recognition, but I won't go into them right now, but broadly speaking, it's the present value of lease payments. And then from a SOFA perspective, the liability and the right of use asset are unwound over the term of the lease. So you'll get an interest expense and you'll get a depreciation charge. This differs to current treatment, whereby the expense going through the SOFA is essentially the payments due for the period. So you may get a difference in the actual quantum charge going through the SOFA in an individual period. So similarly to when we're thinking about the revenue changes for leases, if you are a charity that has a lot of leases, perhaps you've got a large number of lease facilities or, for example, retail premises, then making sure you've got a really robust and accurate register of the lease arrangements you have, and the key lease terms are going to be kind of really important when it comes to assessing the impact of these changes. Right, so let's move on to the SORP. So for this year, very much as you were, so no changes to the SORP, no new information sheets or accompanying guidance has been issued by the Charity Commission. A draft SORP and then the associated consultation on the changes is expected later this year. It won't be before the final amendments to FRS 102 are released, but the effective date and the implementation is expected to align with the FRS 102 timetable. The changes to the SORP will combine, so there have been various SORP working groups and the SORP committee have been looking at for some time now content of the SORP across a whole variety of areas, from lease accounting to donated goods and services. So the changes that are made to the SORP will combine anything arising from that sort of SORP specific process with various other changes that are coming down from FRS 102. But as I say, very much watch this space for now with the SORP. I just wanted to touch briefly on the Scottish charity regulators' review of a random selection of accounts, which was completed last year. Their latest exercise covers around 90 sets of Scottish charity accounts. It's a representative sample, so there's a large number of smaller charities in there, as well as some larger ones. And it really just summarizes the areas for improvement that they've identified from their review. As I say, this is prepared by the Scottish regulator, but I don't think there's anything in here that's not equally applicable to charities that are registered in England and Wales only. So the slide sets out a number of areas where we've identified deficiencies. Typically, this is a missions in the content of the trustees report or a note or the notes to the accounts, which result in non-compliance with the SORP. The one point I just think it's worth pulling out here is around prior comparatives. I think just as a reminder, these are required for all amounts disclosed in the accounts, unless there's a specific exemption in FRS 102 and then the SORP. So that applies to things like the provisions movement schedule, but they are those exemptions are very, very limited. Just moving on. Yeah, so I just have now three other financial reporting topics I just want to touch on briefly. So firstly, cash flow statements. As many of you will know, the FRC releases an annual review of corporate reporting. And that just provides an overview of its activities, its findings, its expectations going forward. So the 22-23 report, which was released a couple of months back, they always include sort of their top findings. Top three findings this year are around, so one, the impairment of assets, two, judgments and estimates and the related disclosures in accounts, and then three, cash flow statements. I think all of those are equally applicable to charity accounts as they are to large corporates that are subject to the FRC's reviews. The one I want to just touch on briefly here is cash flow. The cash flow statements remain the most frequent reason for companies making prior year restatements as a result of the FRC inquiries. And I think this is entirely consistent with what we see in our own review of accounts. Findings continue to be raised on things like the incorrect classification of cash flows between operating, financing, investing cash flows, inclusion of non-cash flow items in the cash flow statement, and inappropriate presentation on a net basis. I think the top tip there on the slide, which is from the FRC's report, is to ensure that you've got a robust issue of the cash flow statement prior to issuing the financial statements, and that being critical to addressing the issues identified. I think I'll just really echo that point, but the other one I just want to make here is to make sure you've really understood what's in your cash and cash equivalents balance. Yes, it needs to be it needs to comply with the requirement, the definition in FRS 102, but make sure your policy is really clear, because clearly, if for an item to be a cash flow and a cash flow statement, it needs to affect your cash and cash equivalents. So if your policy is not very clear, then that's where you tend to get more inappropriate sort of exclusions and inclusions of items and non-cash flow areas. So secondly, on inflation, just following on from Matt's economic update at the start, so this slide just gives a flavour of some of the areas potentially impacted by a higher inflation environment, certainly than we've seen in recent history. Although we've kind of reached and seem to have come down the other side of the peak from an inflation perspective, I think it's important not to lose sight of some of the impacts of inflation on financial reporting, and certainly compared to where we were, say, 2, 3, 4 years ago. To pull out some of these, I think high inflation and rising interest rates may drive significant changes to discount rates and expected future cash flows. So this can have effects ranging from additional impairments, reduction in pension scheme liabilities, potential consideration of whether you recognise pension scheme surpluses for those that have defined benefit schemes. On grant liabilities, as a reminder, the SORP requires discounting of liabilities where the effect of that is material. If historically this has been assessed as immaterial, you should make sure you consider whether that remains the case. I think particularly where we're perhaps seeing more grant makers make larger or longer term commitments, when you couple that with inflation or potentially changes in discount rates, the effect of discounting may not be material. And then just finally, on onerous contract provisions, just remember that they may be necessary where, if you've got contracts or services where costs of delivery have increased faster than the income generated on those contracts. Just be careful if you're slipping into loss-making contract territory. And the final slide, just want to touch briefly on climate and sustainability reporting. So recent years have seen the introduction of reporting based on TCFD recommendations for listed companies, and slightly more recently on for large private companies reporting on under the UK's climate-related disclosure regulations. Clearly few charities fall into the scope of mandatory reporting under those frameworks. But I think just be mindful that when we do anticipate that stakeholder interest, charity stakeholder interest will continue to grow in this area, and more charities may look to voluntary disclosure as opposed to disclosure from a compliance perspective. So if you are making voluntary disclosures, particularly around things like net zero or emission commitments disclosures. I think transparency and clarity are really key. Remember the Charity Governance Code principles around openness and accountability. So when you're thinking about things like level of ambition, the scope of your reductions, what is included and excluded, does a reader actually understand that? Is that how are you communicating that to your stakeholders? How will performance be measured? Again, from an actual compliance perspective, for large charitable companies, the streamlined energy and carbon reporting requirements remain in place and are unchanged. But I think that was my final slide.
Robin, there was just one question that came in around how do you deal with property leases on a peppercorn rent?
So I think I might take that one away. I think the under the standard the recognition of leases are on a recognition of leases the present value of minimum lease payments. But yeah, I'll take that one away.
Great, we'll get back to Hugh. Thank you. Thanks so much. So just in the essence of time, we'll hand over now to Tracy.
Good morning, everyone. I'm Tracy Kenworthy. I'm a director in our forensic services team, specialising in fraud and investigations. I'm going to very quickly today go through some of the key findings from our latest charity fraud survey. There's probably more stats on this slide than I'll be able to cover, but happy to share the slides, and all the stats are covered in our fraud report. If you haven't received it already, please let us know and we can send you a link to download a copy of the report. Just as a brief introduction, this is research that we've carried out in conjunction with a fraud advisory panel. It's in its third year. We started during the pandemic in 2020, and this year we had 121 respondents, which was up from 70 when we first started and launched the first report in 21. We launched this survey in November 2023, so it's reasonably fresh. In terms of the respondents, the majority of the respondents to the survey are charitable companies or charitable incorporated organisations. The largest number had income over 10 million, but the majority were over 500,000. So we had a reasonably good cross-section of charities, although we were missing some responses from charities with lower incomes, which we would be keen to encourage going forward. We had a mix of national, international, local and regional, so a good mix there. And I just wanted to put this in context with the latest British crime survey findings about fraud, not charity fraud specifically, but fraud generally, which estimates that it's over a third in terms of estimated fraud offences, and it's actually half of all recorded crime from police statistics, which is different to the survey estimates. Next slide, please. Thank you. So we asked charities various questions in the survey about their fraud risk and whether it had increased and what might have caused it. I think the key stat here is that 36% thought that they'd experienced more instances of fraud than they had in previous years. Last year, only 30% thought they'd experienced more fraud than the prior year, so there's a definite perception that fraud is increasing. I think, unsurprisingly, 67% agreed that the cost of living crisis had increased the fraud risk over the last 12 months. We had similar results in 2020 when we started the survey during the pandemic. I think we're all aware that fraudsters will often thrive in a crisis as they'll expose any weaknesses and vulnerabilities and seek to exploit them. I think the cost of living crisis also has other far-reaching consequences that might increase the risk of fraud from within a charity. As staff members and volunteers become vulnerable and desperate for funds, and so that is very likely to have an impact going forward. Interestingly, only 37% agreed that hybrid working increased the risk of fraud, which is slightly lower than last year and also lower than the year before during the pandemic. I think this indicates that either charities have implemented more appropriate controls to address any hybrid working risk. It could just mean that we've all become a little bit more comfortable with the way that we're working, and perhaps those risks that are still prevalent are going off our radar slightly. 43% of our charities reported a fraud or an attempted fraud during the year, which is an increase from 36% last year. Of these charities, the majority experienced between 1 and 5 frauds, and 17% suffered more than 10 frauds. And I think if anyone's had an experience of fraud, they will be aware that it can actually have very devastating consequences, and it is a lot of hard work for charities to deal with the aftermath. 64% expected fraud to increase over the next year, which doesn't sound great, but from our perspective, it is some acknowledgement that there is a risk there and it needs to be recognised. And hopefully this will mean that charities will put controls in place to deal with it going forward. Next slide, please. So in terms of the fraud that charities actually experienced, in terms of those who are committing the fraud, 50% were perpetrated by staff members or volunteers or trustees, with the remainder being mainly external forces, be it beneficiaries or suppliers. Often charities didn't know. I think this moving over into the types of frauds that charities said that they had experienced, there was a big focus on misappropriation of cash and assets and expenses fraud, which will be the internal threat. But there were also large volumes of payment diversion fraud and fake beneficiaries and supplier fraud. So I think the key finding here is that there is an equal risk spread across the internal and external threat, and therefore a charity's fraud defences need to be taking both of those risks into consideration when building controls. In terms of detection, 67% were detected through controls, which is perhaps an unsurprising finding. Whistleblowers are also a key detection method, although there has been a slight decrease this year in whistleblowers, in whistleblower reports, which again, tying back to the cost of living crisis, might be indicative that whistleblowers are perhaps more worried about losing their jobs than they are about reporting fraud. Next slide, please. So in terms of the financial impact on charities, this year 92% of charities said that they experienced a loss, which is a big increase from 69% last year. The majority of losses were under 100,000, but 23% of charities experienced losses between 100,000 and $1 million, and a further 4% above 1 million. We did some extrapolation of these results and estimated that potential total losses for our respondents alone could have been around 15 million, with average losses somewhere between 65,000 and 300,000. The positive news is that there was 44% of charities did recover funds after the fraud, which is also an increase on last year. And based on our estimate, that could be a recovery of 6.5 million, but that still leaves 4.5 million that was not recovered. Next slide, please. So in terms of other impacts on charities outside of financial losses, 56% of charities also experienced those types of impacts, and 65% experienced more than one impact. The most prevalent was a loss of morale amongst staff, volunteers or trustees, and 21% went beyond morale issues and resulted in an actual loss of staff and volunteers from an organisation. 25% experienced reputational issues from an external perspective. But I think overall from the results this year compared to last year, there was a higher focus from charities on those internal impacts as opposed to external repercussions, such as opinions held by the public, which could be indicative of how vulnerable charities are feeling, again, through the cost of living crisis. Internal impacts can be managed by being proactive, showing a zero tolerance approach, being open and honest, and engaging with staff members and addressing any cultural issues that may have caused the fraud or may be resultant from the fraud. Next slide, please. So in terms of action taken by charities, very quickly, 75% took more than one type of action, 37% reported to the police, and 35% dealt with the fraud through internal disciplinary action, often in conjunction with reporting to the police. No action taken at all increased from 9% last year to 21% this year. But sometimes this was because they were unable to identify the fraudster, or sometimes another party, such as a bank, was actually taking action on their behalf. There's some remedial actions there. I think unsurprisingly, control changes is the highest, and changes to policies. So these are all positive that charities are actually taking steps to improve after an experience of fraud. So whether or not charities are financially prepared or not, 85% had said their investment has stayed the same or increased during the year. But the worrying statistic is that 10% said they don't invest at all, which is an increase from 8% last year, and 5% said that investment decreased, which is again a worrying statistic in the face of the increased fraud levels and the increase in financial losses. Next slide, please. We asked charities about their policies and procedures in place and whether or not they had fraud risk assessments or fraud training during the last year. These are usually a good indication of how proactive charities are being. Charities gave a good indication that they had conflicts of interest policies, whistleblowing policies and fraud risk registers. And the good news is that there's been an increase in those with anti-fraud policies and cybersecurity policies from last year's results. Very quickly, next slide, please. Obviously, there's a lot of obstacles to preventing fraud, and one of those is the financial investment in fraud. Key obstacles, 57% said the most common obstacle was a culture of over-reliance on trust. Trust is obviously a fundamental part of an organisational culture and often a necessity in charities, particularly the smaller ones, but it's not an anti-fraud control, so it needs to be carefully considered. 48% cited a lack of internal resources, 35% a lack of fraud awareness, 25% IT deficiencies, etc. We also asked charities, finally, what was the biggest future risk going forward? And they all, the biggest response here was cyber. I think this goes to the external threat and how charities are often more concerned about the threat from the external perspective. And they need to be mindful of the results of this survey, which is actually both sides, internal and external, need to be considered equally. So that was my very quick whistle-stop tour on the fraud survey. I think I will now hand over to Peter Lewis, who's going to talk about our reserves research. Peter?
Thank you. Sorry, I'm Peter Lewis. I'm a Senior Audit Manager in BDO's Charity Audit Unit. I'm just going to present back on results of some research we did into BDO reserves. So we looked at the top 50 charities by expenditure, having excluded certain charities such as universities or Wellcome Trust. It was just too large and distorted everything. And then we considered their collective compliance with the recommendations of the SORP. And moving on to the next page, the first thing we looked at was, in terms of that reserves policy in a trustees report, it was just kind of three key questions there of, are they complying with the SORP in terms of, have the charity disclosed the level of free reserves that they've got at the year end, have they disclosed how much they want to hold, and have they disclosed what they're going to do about the difference to bring the two in line with each other. And as you can see from that table on the left-hand side, the first question wasn't too bad, with 42 out of the 50 clearly stating the level of free reserves that they held, but then those results slowly got worse and worse. And so when it got down to what are they going to do about the difference between the reserves you hold and the free reserves you want to hold, less than half the charities that we looked at actually told a reader of the accounts, this is what we're doing about it, this is how we're going to get from where we are now to where we want to be. So clearly that compliance isn't as good as it should be at that stage. So then moving on from that, we then looked at how they've arrived at their free reserves figure. So just as a reminder, the free reserves that you report in your trustees report should be equal to the unrestricted funds for the charity, less any designated funds. And so the key thing we're looking at here is what designated funds have been set up by the charities, and are those designated funds in line with what is set out in the charity SORP. And that table on the right-hand side is just kind of summarising the type of designated funds we found. and some of them made perfect sense. So it's quite common for charities to set up a designated fund equal to the net book value of their tangible fixed assets. So they're really telling a reader of the accounts, we've had this money in, we've spent the money on the fixed assets, and that's giving us benefit over years to come, but we don't have that cash to spend anymore, and hence we've created a designated fund equal to the net book value of fixed assets. And that made perfect sense. Similarly, the pension reserve, where there is a deficit in a defined benefit pension scheme, and a charity intends to fund that from future operating surpluses, again, designated fund set up for that made sense. I think the one area where we did start seeing some charities creating designated funds for operating or contingency reserves, that was a bit more worrying to us. So the idea is that the free reserves charity holds, that should be sufficient to cover those contingencies, operating reserves. In case of problems, if things go wrong, you hold free reserves to give you a buffer. And so you shouldn't be holding a separate designated fund on top of that to cover operating contingency reserves. Thank you. So other examples, so good examples we found in accounts, set up designated funds where there are specific future projects and one-off investments that the trustees want to make, and they talk about that in the trustees report, so really can understand this is where we're going in the future. And then you can see there's a designated fund to put the money to one side to meet that investment that the trustees want to make going forwards. So that's kind of very useful way of linking what you've got in the financial statements to what's in the trustees report. And it's also very good where you create a time narrative around your designated funds, so really can understand when you expect to incur the expenditure that you're putting the funds away in that designated fund, at what point you're going to spend that money. Unfortunately, in terms of bad examples, on top of those contingency reserves I've already talked about, we also had examples where accounts just didn't tell a reader anything about a designated fund, so really could not understand why. They could see that funds being put aside, but didn't know what the purpose of those funds being put aside was for. So that's very unhelpful for readers to understand really what's going on with your reserves. So following on from that, we then made our own assessment of what the level of free reserve should be in each of those top 50 charities. And as part of that, if we saw operating contingency reserves, we were then taking that out of designated funds, adding that back to free reserves. If designated funds weren't explained, we're putting that back into the free reserves. And similarly, there's cases where we found actually free reserves perhaps being overstated, where a charity hadn't designated the net book value of their tangible fixed assets, and so those free reserves looking larger than they should be. And this slide kind of sets out the results of that. So of the 50 charities we reviewed, we felt 36 sets of accounts either misrepresented their reserves, or they didn't give enough information to a reader to properly understand and be able to get to that free reserves figure. And those misstatements are quite sizable there. So the overstatements, about £670 million, understatements of £488 million. Moving on to the next slide. As part of our review of these top 50 charities, we did notice that a small minority don't like the guidance in the charity SORP on free reserves and what should be disclosed in the trustees reports. And they felt it was more appropriate to report on liquidity levels rather than free reserves. I'm not going to say they're right or wrong, but this slide is just setting out the pros and cons of taking such an approach. So clearly the benefits of that allows the trustees to focus on liquid assets, and at the end of the day, cash is king. So if you're focusing on liquid assets, it's very much saying, have we got the cash there to pay liabilities as they fall due going forwards? And sometimes free reserves may not help with that, particularly if you've got a large legacy debtor in your balance sheet. That will form part of your free reserves, but you may not be realizing that asset for a year to 2 years to come, depending on the nature of the legacies you've got in your pipeline. Similarly, if you've got a grant-giving charity, they may be making grant commitments over, say, a 5-year period, and under the terms of the commitments they're making, they're required to book that liability in full on day one. Sorry. But they will fully expect to generate sufficient voluntary income over the next 5 years to meet those liabilities as they fall due. But they can't book that income on day one, they have to book the liability. And so you can end up with free reserves being pushed right down from these commitments, even though they don't intend to use the assets they're holding today to meet those liabilities as they fall due. And because of that, I think that's kind of the reason why people are looking at liquidity. Clearly, the disadvantages to this is potentially open to manipulation. So the finance team could delay making payments at the year end or accelerate payments at the year end, depending on how the reserves are looking. Now, if the liquidity funds are looking too high, pay people fast so you can bring liquidity down. The other way around, if you delay paying people, you can push liquidity up, and that way you can influence the story you're going to be telling in your financial statements. And also worth remembering that if you're reporting on total liquidity, you're going to be including liquidity from restricted funds as well as unrestricted funds in that figure you're reporting. But the cash you've got from restricted funds can only be used for that restricted purpose. So you can potentially kind of muddy the waters here and kind of lose track of what cash you've actually got to pay your general liabilities as they fall due. And finally, it's not in line with the recommendations of the SORP, so there is a risk that the Charity Commission may say your accounts aren't compliant and you should be doing things differently. So the key takeaways, I think, from this research, first off, for you guys, make sure when you look at your accounts, your financial records, you understand why you're holding designated funds. Make sure it's appropriate, you don't have those operating contingency reserves sat within that. And following on from that, understanding that free reserves calculation, making sure it makes sense to you, that you can understand it. Linked with that is then understanding your reserves policy. Organisations will often say we hold reserves for 3 to 6 months worth of unrestricted expenditure, which may be appropriate, but you need to understand why that's appropriate for your charity, given the risk you're facing. Is that sensible? Does that make sense? Should it be different? In terms of cash implications, clearly, once you understand what your free reserves are compared to your policy, that helps you make decisions over what you do with your cash. So your free reserves are higher than policy, you're in a situation where you can make strategic investments, whether that's in operating activities, back office functions or fundraising. You've got that ability to make those investments and try and improve things going forwards. If your cash is less than your policy, that's a much harder situation. So you've got to be very careful about any requests coming in for new investments, no matter what they are, thinking, is this the best thing to be doing, given our cash, our free reserves are less than where they should be to begin with. And finally, checking your financial statements, make sure a reader can understand why you're holding designated funds, what your free reserves are, making sure if I do this review on your accounts next year, I don't put you into that category of non-compliance. Are there any questions coming through, Fiona?
Yeah, Peter, there's one question for you. So was there any data from the research that indicated any reasons for the misstatement of reserves? For example, a lack of knowledge or oversight, or God forbid, it was a deliberate intention?
I don't think you can necessarily tell from the accounts why people have done things incorrectly, necessarily. Certainly, I think there's some organisations who say the restricted funds are, yes, they're restricted, but they're so closely aligned to what we're doing as an organisation that it doesn't make sense to separate the restricted from the unrestricted. It makes better to look at it as a whole. And you do sometimes get that story in the financial statements to explain why they are doing that. But I think that's probably a minority. I think more often where we found differences, it wasn't being explained why people are doing things differently.
It's interesting because I think this is the 4th time that you've done the research. Is that correct? And so it's interesting to see how things have evolved over time.
Yes. Yeah. I'm not sure they're necessarily getting better. I think charities may be getting more complicated, and that is adding to the problems with it. And the requirements of the SORP have been the same for a long period of time now. So there may be something there for the charity SORP committee to consider as well going forward, whether or not they want to think about this and maybe change that guidance. Yeah, definitely. That's a really good point. Thank you, Peter. I'm going to ask all the speakers to come back on screen, and perhaps Tracy could lead on a couple of questions that I think you probably didn't have a chance to have a look at the end of your session. But
There were two or three that I think would be helpfully responded to by yourself.
Sure. So I can see that there's one about cyber fraud here and whether there's been an increase. We didn't specifically gather data on cyber fraud in the first two surveys, but they came through as an other fraud type in that request, in those answers. So we added it this year for the first time. In total, it fell outside the top 5 types of fraud, but we did have 19% of respondents reported a cyber ransomware type data breach and 15% another cyber type fraud. Comparing that with the other categories from previous years, which I've just done quickly offline, it's broadly, it seems broadly the same, but going forward, we hope to specifically capture cyber related data. I think that deals with the first question. Second question was any insights into how responsive the banks are to investigating fraud on charity accounts. I have dealt with a few banks where there's been fraud on charities, and I found in my experience that they've been very helpful and, dare I say, more proactive than the police or the prosecuting authorities, where I've seen the opposite. Where there's been some very clear, straightforward frauds reported to action fraud, and with the help of myself and others, escalated to the National Fraud Intelligence Bureau through internal police contacts that haven't gone anywhere. So I think the banks are coming out more favourably on that side. The final question, how do you begin to tackle an overwhelming culture of trust? Is a really tricky question. So trust is important. We have it at BDO. You will have it in your organisations. The size of an organisation will depend on how much you have to rely on that trust because you don't have the breadth of resource. I think the only mitigating things that you can do here is really focusing on building a culture of anti-fraud awareness. Doing the risk assessments, identifying areas where you're vulnerable and where you might need to focus more attention. Trust is good on the one hand. You also need to have the policies in place to make sure that other people in the organisation can voice their concerns if they see something that they don't feel comfortable with. So it's all of those things combined, but it is something we need to have, and it's important. We just need to also try and verify where possible what our trusted employees are doing.
That's great.
I think that answers all the questions, Fiona. Is there any others?
Not that I can see specifically for you. There's a question around legacies and how they can be designated, and I'll deal with that one directly. But just if you have any other final questions to put into the chat function, please do so in the next minute or so. But otherwise, I think if anything does come through, it's probably easier at this stage for us to reply to those directly. So I'll try and give you a minute back of your time today by thanking all of our speakers for their time and expertise in delivering the session this morning. If you have a further question, then obviously please do email us directly. The session will be recorded or has been recorded, and it will be shared tomorrow or early next week. So BDO's next webinar will be on Tuesday, the 16th of April. So please do look out for your invite and sign up for that soon. We're still thinking about the topics that will be covered in that session, and we'll make sure that that's as relevant as we can do to the things that are interesting our clients and audited entities. We would appreciate it if you could take 2 minutes at the end of the session to complete a feedback survey for us and give us any ideas or suggestions of things that you would like us to cover in any future events, on things that you'd like to hear from us about as well. So thank you again for joining us. Given the number of people that are still on the call right now, it appears as though we've kind of touched on some really useful and interesting topics. So once again, thank you to my guest speakers, and particularly Andrew and Matt, who joined us from organisations outside of BDO. It's great to have your insights. So I wish you all a great rest of your day, and hopefully we'll catch up soon. Thank you.